majority of you have probably heard about trading on the stock market and how you can build wealth from it. But how many of you actually know the different ways you can execute a trade? By being aware and taking advantage of this, you can potentially make better financial decisions when it comes to trading securities on the stock market. Or if you try to use them without fully understanding how they work, you may find yourself dwelling on a 19 million viewed video showing every clip of SpongeBob crying, which I don't know if you noticed, but it's 16 minutes long. But I'll give you hope because everybody watching this video has had some sort of experience when it comes to ordering something, whether that be online or calling into a restaurant and stating that you want to dine in, eat outside, or pick it up, or even have it delivered to your house. We all make choices like this, and if you don't understand stock market order types, that's completely fine because all you need is a video like this that explains it for any beginner. So with that being said, my goal with this video is to show you how to make the simplest trades to ones that give you the skills of a Wall Street pro. And like always, all I ask from you is that you kindly hit the like button on this video. Which, moving on, let's start off with the simplest order type, that is a market order. Now for those that know my channel, I've created plenty of content on Fidelity, and I mention that because I'm going to be showing you examples using their platform on how you can submit every type of order I'm about to mention. So for starters, a market order is the most basic and commonly used order type that pretty much means you want to buy or sell a stock at the current moment. Looking at this example, let's say you want to buy 1 share of Apple stock right now, you would then have to select order type and click on market. By doing this and submitting your order, you're not guaranteed to get the stock at the exact price that's shown, $189.46, because the system may take a fraction of a second to actually execute the order. And so within that extremely small fraction of a second, the price may have actually changed. That means you would have official ownership of the stock at a slightly different price than you anticipated. I mention this because when you go to submit an order, because of simple supply and demand, when you want to buy a stock, it means that someone on the other end needs to be selling a stock. This is important to understand because each stock has a different amount of liquidity, which is how rapidly those shares are being bought or sold without substantially impacting the price of the stock. So for more supply and demand from investors to buy and sell a stock, it improves the likelihood of you being able to have your shares be purchased closest to the actual amount, because that means there are more people on the other end that are willing to buy it from you or to sell it to you. And although this may not have a major effect with high liquid stocks like Apple, there is a chance that you could have a concern if you are to trade a stock with extremely low trading volume. So basically from doing this, you have a higher chance that the stock could actually spike up in that short period of time, and even if you submit your order here, it may not actually go through until up here, and that also might not be instant. And then things that could typically affect the stock skyrocketing or tanking in a very short period of time, which is high volatility, could be a big announcement during the market or right when the market opens or heading towards the close. Now this isn't a huge thing to worry about, but it is something I want you to be aware of going into any trade. Alright, so in my most simplest terms, think of market orders where you can buy or sell an investment right away around the current price. So if you buy with a market order, then you are planning to buy the investment as soon as possible. And if you already own a stock and you sell at a market order, this means you are planning to sell the investment as soon as possible. With that being said, let's now move on to talking about limit orders. Now with limit orders, the volatility in the stock's price doesn't matter because you're going to be specifying what exact price you want your investment to be traded at. As you can see by this image, when you select the limit order, you are going to be asked to specify a limit price. So if you buy with a limit order, this means it's the maximum price you are willing to pay for your shares. And if you sell a limit order, this means it's the minimum price you are willing to get for your shares. Here's an example, and let's say you think Apple stock would be worth purchasing at $185. So what you're going to do from there is type in the amount of shares of Apple you want and then input a limit price of $185. This means if Apple stock is at $189 per share, the maximum price you're willing to buy the stock for is $185. So once that number is hit, and that's if it ever does get hit, then you will officially have that trade be executed and you'll officially own 1 share of Apple. Or say you already own Apple stock and it's sitting at $189 per share right now, but you think it's going to go up a little bit more before having a big downturn, you could then set a limit order to sell the stock if it hits a price of $190. This means $190 is the minimum price you're willing to sell the stock for, and that once Apple hits $190, if it ever does, then the trade is going to be executed and you will officially sell the 1 share of Apple stock you own. Notice how I said if it ever hits the limit price, because there's no guarantee your stock is going to hit that price. Look back at buying a limit order example and say Apple stock never went back down to $185, that means your order would never go through. But another really important thing I want to mention in this video is called price gaps. Price gaps typically refer to when a stock price changes very rapidly where some of the prices are skipped over. This is most common for low trading volume or for many securities, the time the market closes to the next market open. And that could primarily be due to earnings or other big announcements stated outside of market hours, which can have a big effect on the stock's price the next time the market opens. Now, this isn't super common, but if you had an order that was between this point and that point, meaning within the price gap, then there's a possibility your order may not have executed. So remember, when it comes to a limit order, you are stating that you want that specific price or better for your circumstance. For example, if you buy a limit order, you are setting the highest price you are willing to pay for your shares of that stock. Or if you sell a limit order, it is the lowest price that you are willing to sell your shares for. Now, before moving on, something you need to be aware of before you actually make the trade, look to check the time in force. This basically means how long you want the order to be active for. Some examples include a day order, which means the order will be terminated after that day if it did not successfully go through. And then there's also a good till canceled order, which is great for ones you don't think could occur in that specific market day, as it means the order is good until canceled. With that being said, let's now move on to stop orders. Now, moving on, if you do not fully understand market and limit orders, I highly recommend you go back and rewatch, because that is going to be very important for understanding stop orders. So that being said, let's now talk about the first stop order, that is a stop loss. Stop loss means you are attempting to buy or sell an investment at the market price right after it hits a specific price, which is known as the stop price. All right, so let's go back to our example on Apple stock and say it's at $189 per share, and you think it's going to be on an uptrend and you want to buy as it goes up, but you don't want to currently buy. You want to make sure that it starts to go up first. What you could do is buy a stop loss and have the stop price be $191. This means if Apple stock eventually hits $191 or above, it will automatically be purchased through a market order. For example, say the next morning Apple stock actually opens at $192 per share, that will trigger the stop price and your purchase will become a market order and automatically go through at the next available price. All right, so now let's convert this over to selling a stop order, and this is going to make a little bit more sense because you're potentially setting yourself up to stop you from a loss. So say you previously purchased Apple stock at $189 per share and it's now sitting at $197 because of brand new cutting edge technology. You could then set up a stop loss to sell Apple stock at $195 per share to stop any further losses and be assured you have made some profit. So now that you have it set up, let's say the next day it declines because there was speculated news and was just overhyped, so many investors actually sold their stock, and during the next market day it went down to $185. But thankfully you set up a stop loss and got your shares sold around $195. Be aware that with this, if it is trading at $197 after market hours, let's say Friday night, and then come Monday morning right at the open it starts at $185, this defines a major price gap, and this would result in your shares to be sold at $185 and not $195 that was your stop price. All right, so with that being said, let's now move on to talking about stop limit orders. So stop limit orders are extremely similar, but they don't get executed right thereafter. They get executed based off of a limit price. Let me give you the buying example first, and let's say Apple stock is at $189.46 and you set up a stop limit to buy Apple stock where your stop price is $193 and a limit price of $190. By submitting this order, it means that once Apple's stock price hits $193, then it will activate a limit order of $190. And I use this as the example because this way we can be much more assured that the stock is on the uptrend, and if it pulls back a little bit, we'd be happy to have the purchase at that price. So remember that with stop orders, you are going to have a stop price, and once the stock hits that price, it is then going to execute the order, whether that be market or limit order, depending on the one you choose. And with that being said, let's now show you an example of selling a stop limit order. Let's say you have Apple stock where it's currently at $189.46 and you set a stop price of $185 to fulfill a limit order you are selling at $183. By doing this, you're setting up an order where if the stock ends up hitting $185, then it will activate a limit order to sell the stock if it hits $183. Something to be aware of though is that if the market closed above the price, let's say it's currently at $189, but due to terrible news over the weekend, the next market open, it started at $180. Because of this price gap, it means your order would not have gone through, which could be better than a stop loss that would have executed a market order right away, thus giving the stock more time to potentially bounce up to $183 to then sell for you. But this could be terrible if the stock continued to plummet and your shares never got sold. Remember, the function of a limit order is that if you buy a limit order, the limit price is the max price you are willing to pay for the shares of that stock. And then if you sell a limit order, that limit price is the lowest price you are willing to sell your shares for. And remember that when a price gap occurs, it means that there are no traders on the other side in that given moment to buy shares from or sell shares to. Alright, so with that being said, let's now talk about trailing stop orders, with the first one being a trailing stop loss. Now, don't let the name of this confuse you, because it's really not as difficult as you may think. So let's first start off with selling a trailing stop order, because it may be easier to first understand. And let's say we select our unit to be dollars, even though you could do a percentage, and let's say we have it be $5. Now, the percentage and dollar amount have the exact same functions, but when I click out of it, you can see that it has the amount I would receive. As of right now, that would be $184.46. This is because what we're looking at is $5 below the stock's peak price since I placed the order. So let's say the stock continues to fluctuate around its current price, and if anything, it goes down a little bit. And as the stock fluctuates, I am set to sell the stock at $184.46. Since this is a stop loss, it now executes a market order if it hits that price. But what I really like about this is, let's say the stock continues to fluctuate without ever hitting that bottom $184.46. And you know what? Now all of a sudden, I notice it actually reaches a high of $193. That means that my stop price would change because it's trailing $5 below the peak, and now I wouldn't have to sell the stock until it hits $188. So to understand this even better, if the trigger price is not hit and the stock price continues to go up, the trigger price is going to continue going up as well. This is great because say the stock continues to keep going up, the baseline for when I will have to sell continues to grow higher and higher as well. In my opinion, this could be a pretty valuable way to trade if you understand how this works and you have a good tactic going forward. Alright, so with that being said, let's now look at buying a trailing stop loss with the same $5 increment, and after checking this out, you can see that the selling value would now be $5 more than the current stock's price. So basically, the function of this order is the exact same, but in reverse. So instead of the previous point where the stock price goes up, the trigger price goes up. Now with buying a trailing stop loss, when the stock price goes down, the trigger price goes down, because if you were going to buy the stock, you want it to be at the lowest possible price. So if the stock continues to decline, why not have it lower the baseline of when you are going to get into it? Now, like I said, there's also a way where you can do this with a percentage, whether that be 5 or 10% below or above. Just like the dollar amount that's $5 below or $5 above, the system will automatically calculate it and do the same functionality. Now, the last type I'll briefly mention is the trailing stop limit order. As you can see on Fidelity, when you go to purchase this type of order, there is no limit price like the other limit options. So from Fidelity's questionnaire page, you can see a trailing stop limit order has the same function as the normal trailing stop order, but instead of executing a market order at the trigger price, it executes a limit order. Let me show you an example where we sell a trailing stop limit order $5 below the share price. If the stock price continues to climb, then the trail amount will continue to rise with it, and that raises the trigger price. Now let's say the stock price goes up to $195 before it falls straight down to $190, which is $5 below the stock's peak. This now means it has triggered a limit order at the price of $190. Now with a trailing stop order, it would have made a market order and executed right away near that price. But because this is a limit order, it will not execute until the next time it hits $190. And because of that, it may contain more risk, as you're not guaranteed for exit if the stock doesn't hit that price again and say it just completely goes through. So that covers trailing stop limit orders. If you have any questions at all, let me know in the comment section below. If you're interested to learn more about some of my favorite investing apps, I'll have a link in the description below to another video that I've created on that, as well as a link to sign up for my free Money Talk newsletter, where you can get financial topics broken down in a very easy way for you that I highly recommend you check out. I really appreciate you all for watching this video. Share this with somebody you think could greatly benefit from it, and don't forget to hit the like, subscribe, and notifications button for future Money Talk content like this.